Now, the South African Reserve Bank has made an emergency interest rate cut announced this morning. The bank cutting borrowing costs then by 100 basis points, reducing the repo rate, that is, to 4.25%, also then decreasing the prime lending rate to 7.75. This does mark the second rate cut of 100 basis points or more this year after the SARB lowered interest rates for the first time in March, of course. It marks another move by the bank to absorb the effects on the economy of the spread of COVID-19. Now, May's monetary policy meeting was originally scheduled for next week, but the bank has decided to make that emergency move. Let's chat more about this now. Adrian Saville, Chief Economist at Cannon Asset Managers, joins us on via Skype now. Adrian, thank you so much for the time. Appreciated. Emergency move, very necessary, one might say. Surprised at all?
Well, it's unusual in at least two aspects. The first is the extent of the move, 1%, and the second is that it's in between meetings. So I think that this gives you a sense of the responsiveness of the South African Reserve Bank to what are evidently substantially changed economic circumstances, not just for South Africa, but world economies.
Yeah. Adrian, what does this mean, though? I mean, you cut interest rates. Does the follow-through, one, get to the consumer eventually? And, you know, is this actually a move that's going to help, whether it be in terms of growth, whether it be in terms of debt as well?
Look, I think that's a critical point, that the interest rate cut will help balance sheet problems. It's going to help businesses, households sitting with debt on their balance sheet. 1% move on top of the cuts that we've already had this year, that gives meaningful relief to people who are sitting with debt on balance sheets, corporates through to households. What it doesn't do is it doesn't change the cash flow issue. And in the lockdown circumstance, businesses have lost revenue, they've lost cash flow, and that's a completely different asset of the or facet of the financial strength. It's not about assets, it's about cash flow.
Yeah.
And there we need to be looking for fiscal relief rather than monetary relief.
Does this then, you know, do you think that we see the carry trade or the carry through? Do we eventually see that happening very quickly? Or, you know, like usual, does it only come into effect a little bit later on? Do we only see the impact of this interest rate cut later on in the year as opposed to right now?
That's one of the challenges of using monetary policy versus fiscal policy is monetary policy always takes time to work into the system. It takes time for that interest rate relief to make itself felt on balance sheets, whereas fiscal can be immediate and direct. It's almost impossible to know in this circumstance. We are dealing with so many uncertainties and so many moving parts. If there is one silver lining on this cloud, is that South Africa now has 4.25 at the central level of interest rate, and that can be spoken of or regarded as dry powder, whereas in many of the advanced countries, they've cut all the way to zero and even into negative.
Yeah, and they really can't go any further, really, for the most part. Very finally, just wanted to ask you did speak about the fiscal front. We got a 7-page document, speaking notes then from the finance minister, which offer very little in my point of view. What are your sentiments, your thoughts coming out of National Treasury and their response to the COVID-19 pandemic here locally?
Well, you know, they've revised the growth figure down from modestly negative a few weeks ago to -6, which is it's just a horrific number by any reading. But I think that is the extent of the reality, as we are in exceptionally difficult economic circumstances.
Yeah.
What South Africa does have is we've got a very clear policy framework. And at the end of the Minister of Finance's note, he makes the point that if we need any justification for real structural reforms, here we have it, and the call is for those structural reforms to be brought to the fore and to drive South Africa's economic growth substantially higher.
Yeah.
We have to get to that complain.
Yeah, no, look, that's 100% for sure. We definitely need those reforms. My worry is that he also makes note that we do have a buffer available, and that if we're seeing that COVID-19 is going to create prolonged damage to markets, then we will call on the buffer. Are we not already seeing that this could certainly create a longer lasting impact? If we're going to lose jobs, businesses are closing, economic impact is going to be stifled. Should we not be calling on that buffer right now, whatever it is?
You know, we're in the midst of deep uncertainty, and one of the things I think we want to do from a policy perspective is have optionality. And this is different than throwing everything at the problem, including the kitchen sink, which we've seen in other economies. South Africa is in a far more fragile and a far more uncertain circumstance versus some of the more advanced countries. In the US, for instance, you know, how many dollars do you want? They can just keep throwing, as long as they like. In the case of Europe, they've got far more coordinated policy action with their neighbors. So South Africa's circumstance is different, and we do have some available ammunition from a policy perspective. I think it allows us to keep some of that dry.
Yeah. Adrian, appreciated. Really great insight. Thank you so much for that. Always good chatting to you. Adrian Saville, their Chief Executive there at Cannon Asset Managers.